How's it going? All right. All right. So let me just do one little thing and we'll get started. So now we're going to switch our attention to swaps. Now, this one, we're going to actually need Excel for this topic. So if you look in Brightspace, let's see, where are we? I lost it. God, I've got so much stuff open here. But if you look in Brightspace, there will be a like 3 or 4 documents for tonight. All right, let me go back to it again. And so anyway, so for the assignment, what I've done is I've set up a spreadsheet it's called a template because that way, hopefully, it'll be easy to enter your information and let it do a lot of the gruesome calculations for you because otherwise this could take quite a long time. So in other words, um, I've got a swaps template, which is for tonight, and then an assignment template, which is for your homework. And let me just open it up for you real fast, just to give you a look at what it's doing. Um, no. Here we go. Download. Here it comes. Okay. So basically, what it's doing here is it's setting up uh, a template so that you can price an interest rate swap and foreign exchange swap. Oh no, this is the wrong one. Hold on. Oh, it's still opening it up. All right, for God's sake. I mean, this is ridiculous. It's not that big of a spreadsheet. Yeah. All right, you know what? Let me just I don't know what that is. I've had issues, by the way, I've had issues with Excel and Brightspace here, where I would load it up and suddenly it would pop up and it would be converted into a PDF format or something ridiculous like that. So if you have a problem getting at your assignment template, just let me know and I'll physically email it to you. Okay, because I've had trouble with this before. And I kept writing to them and they kept claiming that there was no problem. And of course, I can see for myself that there is a problem. And they just kept saying, no, 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 there's nothing wrong. It works just fine. So the problem, yeah, I was afraid of that. I don't know what that is. So you know what? I'll tell you what. I'll tell you, I'm gonna write a note to myself right now that when we're done tonight, just as a precaution, I'm gonna email you the swaps template because I don't trust the system. Uh, okay, so that way, if you can't get at it on Brightspace, which probably you won't, at least you'll have a copy of it from email. So and you know, I don't even download it myself. I've got my own copies here on my hard drive. So anyway, so what's going on here? We have this is section 3, by the way. And so we're just going to focus 100% of our attention on swaps tonight. Now, swaps are not actually terribly complicated products, but pricing them can be very tricky because there's a lot going on. There's a lot of details. So I have my own template here. Now, this one is called swaps template, and it's already set up. We don't have time to be filling in all these formulas. Oh, I'm sorry to hear that, Shauna Lee. You can watch the recording and it'll be posted on Brightspace and it also will be posted in my YouTube account. So yeah, I'm not sure if you want to be listening to this stuff while you're sick. So why don't you take the weekend off and have fun or have fun, enjoy yourself, at least recover, and then you can worry about this later on. Okay. All right. All right. Anyway, so yes, so we've got an interest rate swap example and two forward exchange currency swaps, I should say, examples. And it looks like a nightmare. There's all kinds of details all over the place, but basically what we're trying to do is show how the cash flows line up between the two sides of a swap and how we figure out their value. And ultimately, all we're really doing is calculating the present value of the cash flows. So it looks, I would say it really looks a lot more complicated than it really is, because ultimately a swap, at least an interest rate swap, is nothing but a portfolio of two bonds. I mean, really, that's all it is. So as we go through this, you'll see that it probably looks more terrifying than it really is. So let's get back to the beginning and see how swaps are structured. We've already started to talk about swaps, but not maybe in this kind of detail. So as we mentioned before, the two basic types of swaps are interest rate swaps and currency swaps, as they're called. And the point of these is to hedge a specific type of risk. For interest rate swaps, what you're trying to do is hedge the risk of a repeated series of exposures to interest rates, as opposed to a one-time only exposure. If that's all you have, let's say there's just one time at which you might need to borrow or lend money, and you're worried about it, and you want to hedge it, you're probably better off hedging that with a forward contract. But if you have a repeated series of these exposures, like if you need to borrow or lend money on a regular basis, then this is when a swap is probably a better structure, because you're locking in advance the rate at which you are able to trade your cash flows to somebody else. The same thing with the currency swaps. You're basically trading cash flows denominated in two different currencies, because you may have receipts from your business overseas, or you might be regularly buying a currency for your own business, or whatever the case may be. So as long as these exposures take place on a pretty predictable, regular basis, then swaps might be the best way to hedge your risk. Now, at the same time, though, it would be insanity to try to use these for speculation, because they're just so messy. If you want to speculate, there are much quicker and easier ways to do it. So these are pretty much being exclusively used for hedging purposes. And so these are traded in the over-the-counter market. These are not available on exchanges like futures contracts are. So that being the case, we can structure them any way we like. But there are certain structures that we tend to see on a regular basis. You'll see what I mean in a minute. But so in spite of the fact that they're completely flexible, there's a certain pattern that they tend to fall into, in particular with the timing of the cash flows. All right, so we'll start with the interest rate swaps. We're going to first understand their basic features. We're going to see how they're priced in the market. And now what's interesting about these is that when you're involved in a swap, initially when the swap is entered into, it has a value of zero. But after that, as market conditions change, the value of the swap will go up for one side of the swap and down for the other. In other words, one of the counterparties will be gaining, the other will be losing, but the two sides always add up to zero. So in other words, if I gain $1 from my swap, the counterparty must be losing $1. So if you look at a Bloomberg terminal, for example, they'll have a price sitting there, and that will show one side of the swap. So like it might show one side, the fixed rate side, let's say, and that's how you know the other side would have the negative of that value. So anyway, so we're going to understand how they're used to hedge and other types of swaps that trade in the market, in particular the currency swaps. There's several others as well. In fact, in principle, there's no limit to how many different kinds of swaps we could create, since they're being traded in the over-the-counter market. So first things first, what is an interest rate swap? So it's a derivative security, of course, where two counterparties agree to periodically exchange cash flows based on the difference between two rates of interest. Now, usually those rates, one rate is fixed, which means it never changes, of course. And then the other rate would be what we call a floating rate, which means it is readjusted or reset periodically, kind of like the interest rate on an adjustable rate mortgage. That would be a good example of a floating rate. Now, by the way, there do exist bonds that you can buy in the market called floating rate notes, where the coupon payment, the amount of interest you earn every year, floats around from one year to the next. And so some investors buy these if they think interest rates are heading up in the future, because if you're right, that means your coupon will go up in the future. But they're kind of unusual. They're rare. You don't see these very often, but they do exist. So the amount of interest, the amount of principal involved is called the notional principal. Okay, so we start with this classic fixed for floating rate swap. So we have to designate a fixed rate and a floating rate. The fixed rate is some constant amount, 6%, 5%, whatever the case may be. The floating rate is tied to some market rate, which used to be, I think we had this conversation already about LIBOR. LIBOR used to be the standard interest rate that was used for floating rate securities. Now, of course, we already know what happened to LIBOR. Just a few years ago, there was a major scandal. Traders in London were manipulating LIBOR to make money at the expense of their clients. So LIBOR lost all of its credibility, and now many new different types of floating rates have come into the market to take the place of LIBOR. In the United States, we have this rate called SOFR or SOFR, and that stands for Secured Overnight Financing Rate, and it is used. It is the rate that banks charge each other for overnight collateralized loans. So it's a very safe rate. The only thing is it's only applicable to very short periods of time. One of the good things about LIBOR is that it had, like you could get a 3-month LIBOR and a 6-month and a 9-month. It went all the way out to 1 year. This is different. These are overnight rates. So figuring out how to extend them out for 30 or 60 or 90 days is kind of tricky. It's not that it can't be done, but it's a lot more complicated than in the past, where you can simply say, all right, let's tie our floating rate to 6-month LIBOR or 1-year LIBOR or whatever. Now we've got some calculations that we have to do to figure out the equivalent of, let's say, 6-month SOFR or 1-year SOFR. But what's good about this is that because it is maintained by the Fed, actually publishes this number every day, so it's not likely to be manipulated. All right, LIBOR was being set by traders at the largest banks in London, and these guys, every so often they succumb to temptation, and they might find themselves in a position to, let's say, take advantage of their clients, and so that's exactly what happened. So yeah, they explain the details here, but it's the Fed that publishes this number, so you can count on it. So here it is. At the moment, it is 4.34% on an annual basis. If you want, you can download all these numbers to Excel, but it's only been around for a fairly short time. Let's see. Let's see how far back all goes. Oh, it's more than I thought. About 5 years they've had this now. But it's only been the last few years that we had to use it instead of LIBOR. All right, now other countries' central banks have their own versions of SOFR. We might be able to put together a chart if we can find it on the internet. What rates are being used instead of LIBOR? Let's see if we can find a chart. All right, so here we go. For example, in England, the sterling overnight index average is called SONIA. That takes the place of LIBOR, British pound LIBOR, which we would have been using in the past. Yeah, they didn't mention the scandal here. I suppose if you wanted to, we could find an article about here it is. What is LIBOR and why is it being abandoned? Okay, this is good. I'll tell you what, I think This is something you might be interested in reading. I'm going to send it to you in the chat room. Oh, I have to God, I do this all the time. Um, all right, there it is if you want to take a look at it. It's just a brief discussion in Forbes magazine about why LIBOR is no longer being used as the internationally recognized floating rate for different types of derivative securities. So I think you'll find that interesting. Anyway, let's get back to this. And so with the fixed for floating rate swap, we've got two counterparties who want to trade their exposures to each other. Okay, so here's a quick example of this. A corporation issues $100 million worth of debt or bonds with a maturity of 5 years and an annual coupon rate of LIBOR plus 2%. So when LIBOR was being used for these floating rate cases, the price or the interest rate would be quoted as LIBOR plus some amount that we would add on to it. So here they're issuing a bond to investors and they promise to pay them LIBOR plus 2% every year. Now, the risk to the corporation, of course, is that interest rates will go up during the lifetime of the bond. And if that happens, the cost of the coupon payments will be higher every year. So that's the kind of thing that makes them nervous. They're starting to wonder now if maybe this was a terrible idea. So instead, let's just say they approach a swap dealer and say, you know what, we'd like to get rid of this exposure to floating rates, and we'd like to replace that with a fixed amount or fixed rate that we can then pay to our bondholders. So how do we arrange something like this? So let's say that the corporation finds a dealer who's willing to give them 6% fixed in exchange for LIBOR for 5 years. So that would typically be every year or maybe every 6 months or possibly every 3 months. It might be every year, but this cash flow will be repeated, this process every year for 5 years. Also, I want to point out that the corporation wants to hedge the risk for the entire issuance of these bonds. So in that case, this amount is the notional principal of $100 million. All the numbers will be, all the interest rates that we will be deriving here will be multiplied by $100 million to come up with the actual cash flows. Okay. So with that being said, now here's the graph. Okay. Now this is a sketch that shows the cash flows. The corporation, down here, this arrow shows us that they're paying LIBOR plus 2 to the bondholders. Now, the bondholders are not being affected by this. They're going to receive their LIBOR plus 2 coupon no matter what. What's changing is how much of that is coming out of the corporation's pocket and how much is coming out of the swap dealer's pocket. So here's the agreement. The corporation pays 6% to the swap dealer and receives LIBOR in exchange for that. Now that LIBOR is passed on to the bondholders, plus another 2% from the corporation's pocket. So ultimately, the net effect of all this is that the LIBOR, the corporation, instead of paying LIBOR plus 2%, is actually paying 8%. Okay, the net amount that's coming out of their pocket is guaranteed to be 8%. So they've changed their exposure to a floating rate to exposure to a fixed rate. Now, if rates go down, they'll probably be sorry about this. But if rates go up, they'll be very happy because it means that they're saving interest. So now the dealer, on the other hand, is now exposed to the risk that interest rates will go up. Okay, you can see if LIBOR goes up, the dealer will have to pay more and more interest every year. So the dealer will probably enter into an agreement with another counterparty to at least partially offset this risk. So the dealer's smart. They're not in the business to take on unnecessary risks. What they are going to do is maybe find another counterparty who will let them get into an agreement. Let's say, let me put this on another page. The swap dealer, I guess we could put them in the middle here. And they're currently paying to the corporation LIBOR, I'll abbreviate that L, and they're getting back 6%. So what they're going to do is find somebody else out there who wants to do the opposite, who has the opposite outlook on interest rates. And so they'll say, listen, you give us, let's say LIBOR plus 0.5%, and we'll give you 6% in return. So you can see they've locked in a profit of 0.5%. Now it might be smaller than that, but this is how they make their money, by getting into these transactions. As you know, they're always paying less interest than they're receiving from somebody else. Yes, go ahead.
So in this scenario, then LIBOR is just basically a pass-through cost.
It is. That's exactly
Right.
right. Set up
So
deliberately.
in the initial scenario where the corporation is paying the swap dealer 6% in exchange for LIBOR, they still need to pay the bondholders. So
Oh,
that pass
yes,
through from the swap dealer goes right to the bondholder plus the 2%.
that's right. Exactly.
Okay,
Yeah.
so if LIBOR is 3%, then the corporation is making 1% because they still need to pay
Right.
out 2% to the bondholder.
Yes,
Okay.
that's right. So now the bondholders don't see any of this. They're just still getting their LIBOR plus 2.
Yeah.
But the corporation now is exposed to their interest rates in a different way. So they were concerned about this, so they decided that they would prefer to pay fixed than floating. And they can't just call out the bondholders and say, we'd like to pay you 8%. It doesn't work that way. They've already obligated themselves to pay LIBOR plus 2. And so therefore, instead of trying to change the terms of the bond, they just swap cash flows with somebody else. That makes more sense from their perspective. The dealer is not really there to gamble on interest rates or to take a position. They're just trying to buy and sell, or in this case, borrow and lend in such a way that they make a small profit on each transaction. So it's no different than dealers in the currency markets where they have a bid and ask spread. They buy at a low price and sell at a high price, and they make money no matter what happens. So here,
In this third bucket here, is this just another corporation that they're setting up an alternate
yeah,
deal with?
this is some other, so let's say this is our original corporation. This could be, let's say, a bank.
Oh,
Um,
okay.
and almost anybody, some other counterparty that's out there. So at any given time, they have positions with all these different counterparties. And so the net effect is that they're trying to make sure that when the dust settles, no matter what happens with LIBOR, they still are guaranteed a small profit. Now, of course, the only thing that could throw a monkey wrench into these plans is if one of these counterparties defaults, which could happen in a market like this. No matter how big these companies are, no matter how safe they are, there's always at least a chance that something could go wrong, or the dealer itself could go out of business. So we're assuming here that all these cash flows actually take place. But once in a while, when a bank fails or something happens, you do see somebody can be left holding the bag and losing a lot of money. So, but the dealer is smart. They know to make sure they don't have too much exposure on one side or the other. So they're constantly finding others to make transactions with. Kind of like a bookie puts bets with other bookies to make sure he's not overly exposed to one catastrophic loss. But instead of being bookies, they're swap dealers. All right. So anyway, so this is a fixed for floating rate swap because the dealer is paying a floating rate in exchange for a fixed rate. So that's where the title comes from, fixed for floating. And the terminology we use in the derivatives markets is that the fixed rate is referred to as the swap rate. So if you were to look at a Bloomberg terminal, the swap rate is the amount that's fixed. Let's say it's 8. The floating rate could be anything. It doesn't, even when LIBOR was being used, not every interest rate swap was tied to LIBOR. It could be literally anything that changes over time. But LIBOR was the most popular because it was a very liquid market, and everybody could get quotes easily from LIBOR rates. And so it was very popular for all those years, and then it just sort of came apart thanks to the greed of those traders at Barclays. But anyway, so now instead we have SOFR in its place in the United States. For other countries, they have, like, for example, I just showed you England has SONIA, but it acts the same way. It's something that changes, it fluctuates, and so it's known as a floating rate of interest. Now, I don't think it's possible to buy a bond, now that I think about it, that's tied to SONIA. I wonder what they did about that. Now that I'm thinking about this, yeah, they well, there's a lot of ways they could work around this. Let me just check something out here real fast. Yeah, I don't know. I'm not sure if this article is what I was looking for. But all right, anyway, so um by the way, as far as the actual mechanics of this trade go, they're not actually trading LIBOR for 6%. They're trading the net difference between the two. So if LIBOR goes above 6, then the corporation pays the difference to the swap dealer. If LIBOR goes below 6, then the swap dealer pays the difference to the corporation. So they're only trading the net cash flows because that reduces the credit risk. Okay. And also, they never trade the principal. There's no reason to because it's a fixed dollar amount. But the cash flows in a swap like this are the net differences between the two interest rates. And again, the purpose of that is to minimize the credit risk. So that means there don't have to be any cash flows at all, but the cash flows go back and forth based on the difference between LIBOR and 6 in this case. And at some point, let's say in this case, 5 years later, then the swap terminates and that's the end of it. So if these are annual cash flows, there'll ultimately be 5 cash flows during the lifetime of the swap. So swaps, they're typically relatively long-term securities. It's a fairly complicated structure to set up. So you usually do this if you only want to do this for a year, let's say. There are quicker ways of hedging your interest rate risk if you're only exposed to risk for a year, but these are much better suited for fairly long periods like 2, 3, 5, 10 years, whatever. Especially when, like I said, the exposure is happening on a regular basis as opposed to once. So like with this bond, it's a good example because we have to make those coupons every year or every 6 months. And so therefore the swap is the best way to hedge this risk. All right. So with that being said, here's my other, I already had this example in here where the dealer goes out and finds a bank to make the opposite trade so that the dealer, no matter what happens with LIBOR, ends up keeping 0.05% in their back pocket. Now you might say, well, that's nothing. But it turns out that on the notional principal of $100 million, that's still $500,000. That's a lot of money. So it might even be a smaller spread than that. I mean, that does sound like a lot. But anyway, this is known as the bid-ask spread. And now, in actual practice, though, you might see something like this. Let's say you're interested in entering into a swap and you contact a dealer. And they say, well, here's the quotes we have for you. So we'll take either side of any of these swaps. We'll either pay floating or pay fixed. It doesn't matter to us. But be aware that at this point in time, the rate that we charge or will pay comes from this table. And you can see for the different maturities, we have 2-year treasury notes actually, and then some spread. And by the way, BP, this is Wall Street jargon. Let me just sneak this in here. Doesn't stand for British Petroleum, it's basis points. Okay. Now, so it's common practice in Wall Street to talk about interest rates in terms of basis points. So the way it works is that 1% equals 100 basis points. So that let's say if if the Fed funds rate, let's say, is lowered from 2% to 1.75%, then it has been lowered by 25 basis points. Now you're probably asking yourself, why do we need this terminology? Why don't we just call it percent? Because the word percent can actually be ambiguous. So let's say, for example, you heard this following statement in the Wall Street Journal. If, let's say, the Fed funds rate is 2% and it is increased by 10%. Well, in principle, let's make this 1%. This could mean one of two things. 2% plus 1% equals 3%, or it could mean 2% plus 1% of 2%. And that means it went up to 2.02%. Okay, you see what I mean? Like if I say it went up 1%, in principle, that could mean it went up to 3, which is probably what it means. This is how people normally use the terminology, but it could theoretically mean 1% of 2%, which means it went up to 2.02. So the beauty of basis points is that you don't have to worry about this because this is an increase of 100 basis points, and this is a 2 basis point increase. So there's no possibility for confusion. So that's why they do that, not to confuse people, not to impress people with their knowledge of jargon, but because it could be confusing if we only talk about interest rates or percentages. In fact, I know I haven't seen him in a lot of years, but I knew somebody who used to be a bond trader, and he said on Wall, just to save a second of time, instead of calling them BPs or basis points, they call them BIPs. The traders say that word to each other. You're supposed to know that they're talking about basis points because apparently it saves enough time that it's worth their while to call them BIPs. Okay, so that's just how it's done. But anyway, so that means then is that you notice how the dealer is locking in a spread for 2 years of 8 basis points. No matter what happens here, the spread is 8 basis points, and that goes up to 9, and then to 10, and finally to 50, because there's more risk with a longer transaction than a shorter transaction. So the spread depends on the level of interest rates in the market, but also the length of the swap. Okay. So what you're supposed to do is take whatever the current treasury note rate is and add the number of basis points to it, and that's your swap rate. But the floating rate side, the fixed rate would be some constant. Now here is a corporation that, let's say 5 years ago, they issued $100 million worth of 10-year 6% coupon bonds with annual coupons. Now, at the moment, they're concerned because they have reason to believe that interest rates will fall in the near future. And that means they would like to swap their current exposure so that they're paying floating rates instead of fixed rates. In other words, it's exactly the opposite of the first case. So let's go look at the diagram. So they're paying 6% to the bondholders. So they have a fixed rate liability, but they would like to change that to a floating rate because they really believe that rates are heading down. So they approach a dealer and say, okay, if we offer you LIBOR, how much will you give back to us? And the dealer offers them 4%. So they accept this, and that means that their net payment, they have to pay the full LIBOR plus they're short 2% here. So their net payment has gone from 6% to 2% plus LIBOR. And so they're hoping that LIBOR stays below 4. Otherwise, they've made a terrible mistake. So the corporation's outlook is exactly the opposite of the bank that we saw earlier. Or actually, it was a corporation too, where these guys were already paying a floating rate. They wanted to swap it out for fixed. Now, this corporation has the opposite outlook. So they want to trade, they're trading away their fixed rate exposure for floating rate exposure. Now, some have suggested that interest rate swaps could be used to reduce borrowing costs. And so here's an example of this. And so you imagine these two corporations, and for some reason, they can, ABC and XXX, they can borrow in the fixed rate market at 5% for ABC or 7% for XXX. So clearly, ABC is more creditworthy than XXX. In the floating rate market, ABC can borrow at LIBOR plus 2 and XXX at LIBOR plus 3. Now, you can see where this is going. You may have heard this concept of comparative advantage from economics. In economics, it refers to a country that can produce goods with the lowest opportunity costs. And so sometimes the results could be surprising. Like it could be that while technically the US can grow more coffee than other countries, they shouldn't do that because Brazil has an even lower opportunity cost in producing coffee. So in that case, Brazil is said to have the comparative advantage, and the US will agree to buy it from Brazil rather than try to produce it at home. But here, what happens is, suppose that, well, first of all, ABC has an absolute advantage in both markets, meaning it can borrow more cheaply, which presumably means a better credit rating. But it has what we call a comparative advantage in the fixed rate market because it can borrow at rate 2% lower than XXX, whereas in the floating rate market, it's only 1%. So ABC has a comparative advantage. When borrowing in the fixed rate market. And that implies that XXX has the comparative advantage in the floating rate market because its disadvantage is smaller.
But doesn't it still have an advantage because it's only playing +2 versus +3 in the floating rate?
Oh, but it's playing one more than ABC. That's the difference. So they're paying 1% higher here and 2% higher here. So where this is leading up to is this idea that if let's say the two companies both need to borrow, but they want to minimize their borrowing costs, what they could actually do is this. They could agree, and let's say it's the same amount of money, just to keep it simple. They could agree that ABC borrows in the fixed rate market. So what's going to happen? ABC borrows in the fixed rate market. And of course, XXX in the floating rate market. So normally you'd say, so what's the big deal? But this is not what they want. So we're going to assume ABC would actually prefer to borrow floating, and XXX prefers to borrow fixed. So in order to carry out this little transaction, they have to borrow in the other market, the one that they're not really excited about borrowing in. So let's say ABC believes that interest rates are heading down. Okay, so they have opposite outlooks about interest rates in the future. So suppose that ABC believes that interest rates are going to fall in the near future. And XXX believes the opposite. So ABC normally would like to borrow in the floating rate market. while XXX would like to borrow in the fixed rate market. And they could very well do that, but look what happens here. Because there's a discrepancy in how much extra they have to pay in one market versus the other. So what's going to happen is ABC and XX can then borrow, or actually, let's put it this way. ABC can borrow in the fixed rate market at 5, while XXX can borrow in the floating rate market at LIBOR plus 3. And then the two companies can swap cash flows with each other. What in the world is that going to accomplish? Let's see if I have a diagram here. Yeah, here it is. So here we go. So ABC goes into the fixed rate market and borrows at 5. They have to pay 5% every year for the next so many years. XXX goes in and borrows at 3. And now they say to each other, listen, ABC says, I really would like to borrow floating because I believe rates are heading down. XXX says, I have the opposite outlook. So look what they decide to do. ABC pays LIBOR to XXX in exchange for a fixed 3.5%. So you're saying to yourself, well, what is the net cost to ABC? It's up here. They're paying 5 plus LIBOR in exchange for 3.5%. Their net expense is LIBOR plus 1.5%. For XXX, they're paying 3.5 and 3 and LIBOR plus 3 down here. So they're getting back LIBOR from ABC. So their net cost here is 6.5%. Okay. Now, here's the thing, though. If they had gone into these markets in the first place, if ABC had just directly borrowed floating, they would have had to pay LIBOR plus 2. But instead, they're only paying LIBOR plus 1.5. Whereas for XXX, they're paying a net amount of 6.5%. But if they'd gone directly into the fixed rate market, it would have cost them 7%. So each one of them just saved percent.
So because they believe that XXS believes interest rates are going to go up, if LIBOR goes to 7, then they're making 0.5% versus ABC not having. Basically, they're paying now.
LIBOR plus 1.5.
It would be 12, so it would be 8.5% if LIBOR 7,
So,
for instance.
right. So what ends up happening is no matter what happens though with these rates, their borrowing cost is cheaper for both of them than if they'd gone and borrowed in their preferred market in the first place. So by entering into this agreement, each of them, they saved a total of 1%, which they split evenly between the two of them. And so this is what this concept of comparative advantage refers to in this market. So now in Hull's book, he'll say, well, listen, this is all very interesting, but in practice, markets are so efficient that it's unlikely that you'd be able to find an opportunity like this because the cost of borrowing should reflect very accurately the risk associated with each of these corporations. So he says that it could theoretically happen like this, but it's going to be very difficult. Okay, it's not like something that can easily be done because the spread between the two would probably be closer to 1. Or it would be much more reflective of the difference between the credit risks of the two counterparties. But it's a good example to show one of the things that we could potentially do with interest rate swaps to not just change our exposures, but to also potentially at least save on borrowing costs. But anyway, so this is the table, just summarize everything in case we overlooked anything. It's all listed right there. it's just like when countries trade with each other. If the United States trades high-tech products to Brazil for coffee, both countries gain because they would have found it much more expensive to produce those goods for themselves. And so that's why this is sometimes called comparative advantage, because if you do what you do best, you're going to, and possibly trade your surplus with somebody else, you might end up saving money. Yeah, so the weakness, I mean, it's there, Hull will mention that differentials like this would probably more accurately reflect the differences in credit risk. So in other words, what Hull is saying is that, they could try, but in practice, if there's a gap of 2% here, there will probably be a gap of 2% here or very, very close to it because of the difference in credit risk. And so there goes the advantage. But you never know, you can try. Now, pricing, this is the challenging part. The price of a fixed or floating rate swap equals the difference between the present values of the cash flows from the two sides of this transaction. Initially, the swap is set up to ensure that the price is zero for both sides. Okay, that's how this is done. Now, oh, by the way, I'm just want to mention this before we get to that point, but you'll see later on in this chapter, they're going to tell us that we could think of an interest rate swap as either an exchange of bonds or an exchange of forward contracts. So when we first enter into this contract, the net value is the same for both counterparties. It's like let's see that just to keep it simple. I mean, imagine that here's a good scenario. Suppose we have islands, and on this island they can only grow corn, and on this island they can only grow wheat. And so they agree we're going to sell 100 units of corn for 100 units of wheat. And let's say they each cost, $100 a bushel. So right now the swap has the same value to both sides. I'm trading $100 worth of corn for $100 worth of wheat. Fine. So everybody's happy. But if tomorrow the price of corn goes up, that means that from the corn grower's perspective, he's behind the eight ball now because he's trading corn that's more valuable than $100 for wheat, which is still worth $100. But then the next day, if the price of wheat goes up, then it's the other way around. So the value of the swap will fluctuate every single day to reflect market conditions. But when we start out, it's set up carefully to make sure that it has the same value to both sides, which means the net value is zero. So any day after that, it will have a price for both sides. One side will have a positive price, the other have a negative price. The two will add up to zero, because this is what we call a zero-sum game. You probably heard that term before. It means the gains of one side are matched by the losses of the other. Because we can't both win. It's like a football game. Both teams can't win. So the gains of one player match the losses of the other player. So a swap is a zero-sum game because if I gain, the counterparty has to lose it and by the exact same amount. So the price tells me how much one side is gaining and how much the other side is losing. So we can think of the swap's cash flows as being a fixed rate bond and a floating rate bond, where you own one, you buy one and you sell the other one. In other words, depending on what side you take, And keep in mind too, because a bond has a regular series of cash flows, we can make the claim that suppose an investor buys a $1 million 6% coupon bond with annual payments and a maturity of 5 years. The same investor sells a $1 million bond with a LIBOR coupon and annual payments for 5 years. So what ends up happening there is that the cash flows, you can think of them like this. So you've got a timeline with, this would be 0 today, 1, 2, 3, 4, and 5. So I just bought a $1 million fixed rate bond. But I've sold a floating rate bond down here. So I pay $1 million here, but I collect $1 million here. And now I'm going to collect 6%, which is $60,000. And then I get my money back. Down on this side, I'm paying LIBOR. So the net difference between these are the cash flows from the swap. These exactly offset each other. Okay. So in other words, when you are in a position like this, now, if you notice, this owner owns the fixed rate bond, but he's short the floating rate bond. So he's in a position, this is equivalent to being what we call the fixed rate receiver in a swap. So there's with an interest rate swap, one side is defined as the fixed rate payer and the other is the fixed rate receiver. So I'm collecting the fixed rate, I'm paying the floating rate. So having a portfolio like this is equivalent to being the fixed rate receiver in a swap. Sorry, let's just say swap. Now, the reason why that matters is because if I can calculate the market price of that fixed rate and floating rate bond, the sum of those two would give me the price of the bond, the swap rather. Okay. So in other words, suppose that it turns out that based on current market conditions, fixed rate bond is worth 1,200,000 and the floating rate bond is worth 900,000. Then the value of the swap would be $300,000. Now, whoever is on the other side of my swap, I'm the fixed rate receiver. Whoever's on the other side of my swap is the fixed rate payer. The fixed rate payer has the same position as an investor who buys a floating rate bond. sells a fixed rate bond. So that means in this case, value of the position of the swap would be 900 minus 1.2 million equals minus $300,000. Okay, so if I'm up 300,000, the other side of the position must be short 300,000. It's like imagine you're playing poker with somebody, at the end of the night, if I won $100, the other side must have lost 100. That's the only way it can work. But the important thing here is that by setting it up as a portfolio of bonds, it's easy to price these bonds. So therefore, I can easily figure out the appropriate price of this swap. Uh-huh. So that's what we're building up to. Now, the other option, which we'll see later on, is to treat this as an exchange of forward contracts. Now, we haven't actually discussed this just yet. We'll have to save a little bit of this for another time, but a forward contract written on an interest rate is often referred to as a forward rate agreement. For example, is a forward contract in which an investor can lock in a rate, borrowing rate, or a lending rate in the future. So, for example, you might agree an investor enters into a forward rate agreement or which is abbreviated FRA to borrow $1 million in 6 months for 5%. Okay. So this is an example of a forward rate agreement. So a interest rate swap is equivalent to entering into a sequence of these forward rate agreements. Okay. And we'll see that later on. Depending on which side you're on, an interest rate swap is equivalent to either a sequence of forward rate agreements in which the investor locks in a borrowing rate or a lending. Either way, you end up with the same result. All right. So see, let's take a look at my Excel example here. What we're assuming in this example, that this is our interest rate swap example, and you can see that we're going to be, this will be a fixed for floating rate swap. And let's see. So we're going to assume that in this case, the payments are made every 6 months or half a year. The notional is $100 million for both bonds, the fixed and the floating rate bond. The coupon on the fixed rate side is 5%, which means $5 million. And over here, the notional is 100 million. The coupon rate is currently 3.5%, and that's $3.5 million. Now, before we go any further, I just want to mention something here about the way floating rate notes are structured. And that would be this. So let's say you've got a 5-year that an investor buys a 5-year floating rate note. With annual coupons tied to, just keep it simple, 1 year of LIBOR. So how does this actually work? How are the rates reset? Well, let's do a timeline here. And so we got 5 cash flows. Here's today, 0, 1, 2, 3, 4, and 5. Well, the coupon here at year 1, I want to write it as L0 because that's the 1 year LIBOR rate. Let's say that it's 5%. So on today's date, time 0, the 1 year LIBOR rate is 5%. I'm going to call that L0. So in 1 year, the coupon is 5%. And at that time, we observed the new 1 year LIBOR to be, let's say, 6. And we'll call that L1. So in year 2, the coupon is 6. And then we also reset 1 year LIBOR. Say it's back to 4. And then it goes on and on. So there's every year, the coupon that we observed came from last year's LIBOR rate. So it's this number is determined 1 year ahead of time. So on year 1, I not only collect my 5% coupon, but I know that next year I'll get a 6% coupon. But I don't know what to expect in these years. I know what's happening 1 year from now, but that's it. Because the rate that's being set today will determine the coupon rate in 1 year. So this means that the coupons are set. It's called in arrears for some reason after the fact. After, in other words, they're set based on what, like right now, we're determining next year's LIBOR rate. I guess it's kind of like every year we decide where the next Super Bowl is going to be. All right. So when they play the Super Bowl in New Orleans this year, it was announced, let's say that next year it'll be in Phoenix or something like that. So we always know 1 year ahead of time what next year's coupon rate will be, but that's all we know. We don't know any of the rest of them. Okay. Now that's an important detail because you'll see this structure will make it simpler to price the floating rate bond. Because when you think about it, how should you price a bond whose future cash flows are not known today? That's a tricky challenge. So anyway, let's take it from there. So in this example, we have a case where 6 months ago, a 4-year fixed or floating rate swap is entered into. The notional is $100 million on both sides. And the floating rate is 1 year LIBOR. The swap rate, which is the fixed rate, is 5%. That never changes. Okay. That means the annual coupon is $5 million. Over here, it turns out that when that swap was first entered into, the 1 year LIBOR rate was 3.5%. So that we already know. And by the time in 6 months, when the first coupon is due, it'll be worth 3.5%. Okay, so in 6 months, we can count on getting a coupon of 3.5%. So the swap we're about to enter into, if you're the fixed rate payer, it's equivalent to buying the floating rate bond and selling the fixed rate bond. If you're the floating rate, fixed rate receiver, it's the other way around. So let's say that LIBOR of the next year is, let's see, I think I have it here somewhere. There it is. 4, 4.5, 5, and 5.5. By the way, this is continuously compounded. Hull loves continuous compounding. This rate doesn't have to be continuously compounded. I think John Hull just loves it that way. But often with the derivatives markets, as we've seen, we have continuously compounded rates of interest. Sometimes it's really important and sometimes it's not. Okay. So anyway, oops, I think here we go. Oh, right. So let's see what's coming next. So given the term structure of interest rates, we should be able to figure out without any difficulty the prices of these two bonds. So let's take a look at this chart. Now, remember, the next cash flow is in 6 months. After that, they're 1 year apart. So the next cash flows occur in time 1.5, 1.5, 2.5, and 3.5. So we're going to start by pricing the fixed rate bond. As we've seen up here, each coupon is worth $5 billion. At the end of the 3.5 years, we also get our principal back. So if you really owned a bond worth $100 million with a coupon of 5%, those are the cash flows you get. Now, because we already have observed that the 1 year LIBOR 6 months ago was 3.5%, that means the floating rate note will have a cash flow of 1 million plus 3.5% of the principals, or $103 million, $103,500,000. Now, we don't know what the other ones will be. It turns out that it doesn't make any difference. Okay, because you can think of this as a bond where you basically start all over again every year. So the value of the bond to you now is worth that much money because it's as if you're starting all over again, meaning that you'll collect your coupon, you get your money back, and you start with a new bond. So the next thing we have to do is calculate the present value of these cash flows. So if you notice, because we have continuously compounded rates of interest, these discount factors are based on E, which you know is used to calculate present values with continuously compounded rates of interest. Okay, so if you took, and you see the form is right here, by the way, E, which is Excel speak for EXP is for E to the X, and we need the negative of the rate of interest on an annual basis and the time, which in this case is half a year. So that means that $1 received in 6 months is worth 98.02 cents today. We do the same thing for a year and a half, 2.5 years, and 3.5 years. All right, so these are called the discount factors. They tell me how much $1 received in the future is worth today. Then I multiply these by the actual cash flows to come up with their present values. So for the coupons, you can see we're multiplying columns B and D to give us this number. Okay. So like for this first one, that means that having $5 million in 6 months is the same as having 4,900,993.37 today. Okay. So this is, by the way, this is how all fixed rate bonds are priced. When you add these up, you get the market price of this fixed rate bond. The floating rate note, we only have to deal with one cash flow. We calculate its present value, and there you go. So you can see that remember, I'm the one who is entering into the swap. If I'm the fixed rate payer, then I'm ahead because I'm receiving the floating rate cash flows and I'm paying the fixed rate cash flows. The difference between the two is about $850,000. Fixed rate payer is equivalent to having being the owner of the floating rate bond and the seller of the fixed rate bond. So therefore, I'm ahead. The floating rate pair is the opposite. It's as if they bought the fixed rate bond and sold the floating rate bond. Since the floating rate bond is more valuable, the spread between them is the same, but it's negative 849, 542.79. So the sum is zero, but if you look in your Bloomberg terminal, you'll see this number as the price of the swap. Okay, with the understanding that one side is up that much and the other is down. Now, the relevance of this is that if I called up the counterpart and said, listen, I don't need to be in the swap anymore, how much will you charge me to get out of it? That would be the correct number. Okay, so let's say the floating rate pair, normally, you follow through with these all the way to the end, but sometimes you can negotiate an early settlement, and that would imply that the floating rate pair owes the fixed rate pair $849,542.79. Okay. Now, of course, tomorrow, these numbers could change, and these could reverse each other. Every day, interest rates will fluctuate. The cash flows are fixed, but the interest rates are not. And of course, as time evolves, these numbers will change too. How much time until the next cash flow? So these numbers will get smaller. These can fluctuate, and that can affect the value of the entire structure. Okay, so that's our fixed for floating rate swap. Wow, well, that wasn't so bad. Well, yes, it was, but there's a lot going on.
Yeah.
There's a lot of details. But that's why I set up that template so you can do this with your examples. You basically just have to provide the right numbers, but you see, you're comparing the present values of the fixed and the floating rate bonds. So depending on which side of the swap you're on, that will determine the value of the swap to you. Yeah, you see why Excel is so heavily used on Wall Street. Imagine
So
trying
the
to do this by
higher
hand.
the LIBOR, which is continuously pounding,
Right.
will continue to like the discount factor will go lower
Down.
even faster,
That's right.
which means
That's
that the
right.
present value for the forward rate note will end up being higher than the forward rate note cash flow.
Well, I'll tell you what, let's find out. We got four. I'm going to copy these over here so I can't forget.
Yeah, I mean, once it gets to 5.5% and your coupon rate's 5%, then the right side should be higher than the left side.
So yeah, see what happened was the floating rate bond. See now the shoe's on the other foot. The swap has a value to the floating rate pair, but it's a loss to the fixed rate pair.
Yeah.
Now, of course, those numbers had to go down by 100 basis points, which is a lot. What if it's even something trivial like 395, 445, 495, oops, 505 rather. So, well, it's still valuable for the fixed rate pair, but it's not, it's a little different. So, all right, well, anyway. Oops, well, that's not what I wanted to do. I better not upset it. All right, so now we're back to where we started out. Very good. All right, so now that's kind of it for fixed rate interest rate swaps. So in the slides, we have the exact same example. It's just that it's not in Excel. I think Excel is really the way to go here. But now currency swaps are different because, of course, the cash flows are in two different currencies, but also we tend to trade them based on fixed interest rates in the two countries that are involved rather than floating. Although you can, I think I did say before, you can negotiate anything you want here. So you could have floating rates and fixed rates with a currency swap. The standard approach is to have fixed rates. Also for the interest rate swap, the floating rate could be literally anything. It doesn't have to be LIBOR. It could be the Fed funds rate, or it could be a lot of other things. It depends on what the two parties are interested in. So here, one of the most important differences, though, is that with we saw before, with an interest rate swap, the notional principal is never exchanged. Again, this is for credit reasons. That would just put too much credit risk on the two sides. So instead, the net differences between the fixed and floating rates are exchanged. Again, to keep the cash flows down to a minimum and minimize the credit risk. Currency swaps are different because you're dealing with two different currencies. So you actually will see an exchange of principals or notionals at the beginning and the end of the swap. The currency swap, since there are two different currencies involved, there is an exchange of notional principal between the counterparties at the beginning and the end of the swap. And sometimes that's part of the reason for entering into one of these, that you want to maybe borrow in a foreign country, but you want to hedge away some of the risk that you're taking with the exchange rate. So we'll see, that's kind of the motivation in the next example. So here we go. A US corporation wants to buy a 5-year, 100,000 pound bond that offers a 6% coupon rate. Let's say they want to buy a bond issued by, I don't know, Jaguar. Now, it's possible Jaguar already belongs to another company, but let's say it's Jaguar. And because they hope to take advantage of the differential in interest rates between the two countries, but then, of course, they're exposing themselves to foreign exchange risk. If the dollar gets stronger, the British pound coupon payments that they receive will be worth fewer US dollars, and they could end up losing money. So because the cash flows they'll be receiving are predictable, it might be good to hedge our risk using a swap, a currency swap specifically. So how would that work? So the corporation now they're paying 100,000 pounds. In exchange for this bond. Let's say this is the issuer of the bond. Just to keep it simple. In exchange for that, they receive a bond which will pay them 6%, but in pounds. Plus repayment of principal at the end, of course. Okay. So the US corporation buys the bond, 100,000 pounds. They get a 6% bond, which means 5 years of payments of 6,000 pounds, because it's 6% of 100,000 pounds, plus repayment of the notional of 100,000 pounds in 5 years. Okay. Now, assuming the exchange rate is $1.90 a pound, which of course is way off for today, but it wasn't that long ago that there was a time within the last 10 or 15 years, the pound has ranged from slightly over $2 a pound to just slightly over $1 a pound. It's been quite a roller coaster ride for the British pound. Um, although that's not that unusual in the foreign currency markets, but they've had some really strong years and some really ridiculously weak years. So, as tourists in those countries, we just pay whatever the price is. But if you're doing business in these countries, this is a real cause for concern. But anyway, the exchange rate is at $1.90 per pound. Then these cash flows will be, the coupons will be worth. So you multiply it out and you get $11,400. And the principal in order to acquire the 100,000 pounds, we're actually paying 190,000 US dollars. All right. So, but if the dollar strengthens, those coupons, suddenly you're only bringing us $10,800 a year. And this is what they're concerned about. They're like, listen, this is fine as far as it goes. If exchange rates never changed, we'd be very happy right now because we're paying 190,000 for this bond, bringing in 11,400 per year, and then at the end we get our money back. But what happens if the dollar gets stronger? There goes our coupons. So what they're going to do is enter into a swap in which they pay a fixed rate of interest in pounds, but receive in exchange for that a fixed rate of interest based on dollars. So let's just say that it is 6% pounds versus 5% dollars, with a spot exchange rate of $1.90 per pound. So again, we start by paying 190,000 for 100,000 pounds, which means that we can buy the bond. And then, because we're collecting a 6,000 pound coupon, we trade it to the dealer for $9,500. 6 for 5. So this is what it looks like. Okay, the dollar amounts aren't there, but you've got the interest rates. The U.S. corporation owns the bond from which they receive 6% per year. They then trade that directly to the swap dealer in exchange for 5% US. Okay. So now, in addition, although it doesn't show it on here, the US corporation also pays $190,000 initially in exchange for 100,000 pounds. And at the end, we reverse that. In 5 years, in other words. So it's a little bit messier than the interest rate swap. And in the meantime, we have these cash flows. Okay. So in other words, the dollar amount here, 5% of 190,000 is 9,500. And our 6% coupon we're trading it away to the dealer. So the net effect to this, if you notice this US corporation, is that they're guaranteed to get $9,500 per year. They trade 190,000 initially, they get that back. So it's equivalent to from the US corporation's perspective, This is equivalent to buying a 190,000 US bond with an annual coupon of 9,500. Okay. So notice the cash flows end up being the same as if that's all we were doing. In reality, we're buying a British pound bond and swapping out the cash flows for dollars. But the net effect is it's the same thing as if we went out in the market and bought a $190,000 bond and received in exchange for that a $9,500 coupon. Now, why are we doing this then? Why don't we go into the US market and do this? Because maybe this bond doesn't exist in the US. Maybe the bonds in the US are paying lower coupons. And so this way, we're trying to earn a higher rate of interest by combining our British pound bond with a swap. Now, Hull might argue that this shouldn't happen in an efficient market, but it's still possible that this could help us earn a higher rate of interest by taking advantage of the discrepancies in the interest rates in the two countries. Okay, so now here's the thing. How do we price this bond? I mean, the swap. Now, this one is a little bit messier. I'm sure you'll agree. Let's see. We're going to treat this as if we have two bonds, a British pound bond and a dollar bond, and we buy one and sell the other. So in a lot of ways, it's just like what we did before, where we bought a floating rate bond and sold a fixed rate bond, or vice versa. Except now, instead of one being floating and one fixed, they're both fixed, but one is in dollars and one is pounds. So we've got the terms and conditions up here. And so here's the $9,500 cash flows that we're getting from the US bond. This is the price. Now at the end, we get our principal back of 190,000. In Britain, this is the cash flows to the British pound bond. Now, the interest rates we're assuming are 3% in the US and 5% in the UK. All right. And we're using continuously compounded rates like we did before. So the present values are here. So in other words, this US bond in principal is worth $206,985.33. The British pound bond is worth 103,765.92 pounds, but at the current exchange rate, that's worth $197,155.24. Now, keep in mind that with this swap, where I'm trading away pounds for dollars, it's equivalent to buying the dollar bond and selling the pound bond. So that means that my position is the difference between these two numbers, which means I'm up 98.30, whereas the dealer is down 98.30. So in other words, I'm paying pounds for dollars. Therefore, it's as if I own the dollar bond, but I'm short the pound bond. And the swap is therefore worth, in my favor, 98.30.09. So now if you remember, I mean, it's true that I bought the British pound bond, but I then sold it in effect to the dealer in exchange for the dollar bond. So I'm in long the dollar bond, short the pound bond. So the difference between the two is the position for me. And of course, the opposite must be true for the dealer. They're down 98.30.09. Wow. That was pretty messy.
So you start off buying the pound bond, then you flip that to the swap dealer at 6%.
Right.
Then you
And
are buying
the
US
dollar
dollar
bond.
at 5% coupon
Right.
rate.
Right.
And then okay.
So if interest rates, or now if the exchange rate fluctuates, you notice if the exchange rate changes, my position will change too. It's not just if these interest rates change, my position will change, but also if the exchange rate changes, the value of the swap will change, but the actual cash flows won't change. So I'll still be getting my dollar cash flows, but it's the swap itself whose value will depend on both interest rates in the two countries and exchange rates. Now, of course, in practice, exchange rates are much more volatile than interest rates. So really, this is the driving force behind what this swap is worth. Like, let's say I made it $1 or $2. Oh, I just made money. Let's change it to $1.80. Oh, I'm still doing okay there. Yeah, there's going to come a point though where suddenly it moves against me. Okay. So that's one way we can price a currency swap. Now, there's an equivalent way using forward contracts. I don't know if I don't think the assignment asked you to do it this way, but why don't we take a quick look at this and see how it ends up giving us the same result. Now, if you remember from last time, we talked about forward contracts, and this is the one that applies specifically to foreign currency forward contracts. It's referred to as interest rate parity, and you notice this is the formula for calculating the forward price of an asset when the asset has some form of cash flows that accrue to the owner. So here we're going to set this up as if we bought five forward contracts, each maturing 1 year in the future. So in other words, I have a forward contract that matures at 1 year, 2 years, 3 years, 4 years, and 5 years. So I'm trading my cash flows in this assumption using this forward exchange rate to determine the value, the dollar value of these of these pound payments. Okay, so in other words, I know that I'm collecting $9,500 a year, and at the end I get my $199,500. In exchange, I'm paying to the dealer 6,000 pounds, and at the end, I'm giving him 106,000 pounds. So the question is, how much is this worth in dollars? Okay, so in other words, what I've done is I've taken the forward exchange rate, which I've calculated here with this formula, and again, you can see that's going to depend on the interest rates in the two countries and the spot exchange rate. But these numbers here are taken from the product of these two columns, which means that the 6,000 pounds that I'm delivering to the dealer in 1 year will be worth, in today's dollars, $11,174.26. So all of these represent how much would it cost to deliver this many pounds at this point in the future in dollars. So we add them up. Now here's the net cash flow. This is simply the difference between these two. Wait a minute. No, sorry, between these two. And then what really is relevant, though, is that those cash flows take place in the future. So we need to know their present values. So we use the US rate to figure that out. And so, in other words, these net cash flows are converted to these present values. And when we add them up, this is the value of the swap to the corporation because I'm collecting dollars. And then the opposite of that is what it's worth to the dealer because they're paying dollars. So you notice it's the exact same price. 9830.09. It's not a coincidence. So, Hull wants you to see that the two of them, these approaches are equivalent to each other. Although I think intuitively it might be more clear with this approach because you're just seeing how the difference between two bonds is determining the value of the swap. Wow. Oh my God. And that was a lot of calculations. Yes. All right. So we can kind of skip over that now. We're done here. Now, there are other kinds of swaps, as I mentioned earlier. These happen to be the most widely traded, I would say, but there's a lot of others, given that these are traded in the over-the-counter market. Since we can have complete flexibility, it stands to reason that many other types of swaps are being used as well. So what are some of the most common ones? Equity swaps. Now, with an equity swap, the total return to a stock, which includes dividends, by the way, plus capital gains, is exchanged for a floating rate of interest. Now, why in the world would you want to do this? Okay, let's say that you are, here's the example. A pension fund owns $1 million worth of IBM stock. Let's draw a picture of this. Yeah, these are the kind of people, yeah, they really have to be careful with their investors' money here. Um, Here's the pension fund. IBM stock pays them. Well, I guess we could, in our diagram, we could show capital gains plus dividends, let's say. Now the pension fund is like, we are pretty sure that IBM is running into a rough patch right now, but we don't want to sell the stock, all right, and then have to replace it later on. Let's just ride it out. Why don't we do this? Why don't we contact a swap dealer and say, listen, we'll trade to you these returns. Oh, what happened? Here we go. And what will we get back? Let's say it's LIBOR. Although it doesn't have to be a floating rate, it could be a fixed rate as well. So what have they done? Well, if they think IBM's going to be in a rough patch for a year or two or whatever, but they don't want to sell the stock either, they can just say, well, listen, we'll trade these to the swap dealer for some rate of interest, and that way we get some interest or rate of return, which if we're right and IBM is going to be in trouble, those capital gains would actually be losses. And by the way, if we trade capital gains to the dealer and they do turn out to be losses, the dealer has to cover those. In other words, if the company loses 10%, the dealer has to pay us that 10%. So we're actually getting out of this position temporarily in exchange for LIBOR or some other rate of interest. So you can see why this could potentially be interesting, because it lets you rearrange the pattern of your cash flows without having to sell anything. This should be especially important with bonds. Bonds are notoriously illiquid. If you had $1 million worth of IBM bonds, you could find yourself needing to wait a long time before you can find a buyer if you wanted to sell them. And you might not get the price you're hoping for because they're illiquid. So this would be a good way to rearrange the cash flows you're getting from some highly illiquid asset. But because we're trading the returns to a stock for some rate of return, we call this an equity swap. Now, commodity swap instead of having a portfolio of, let's say, stocks, you have a portfolio of commodities. And now, of course, commodities can provide a rate of return as well. So we have two possibilities here. We have fixed for floating and commodity for interest. Yes,
Yeah, a question to go back to the IBM example. So you
yes.
enter into a deal with a swap dealer. The total return on IBM stock over the course of what's the period of
Let's
time?
say, it doesn't say, let's say it's a year.
Okay, so if the stock's at 100 but it goes to 90 in the course of a year, then that $10 you have to pay to a swap dealer
No,
versus,
actually, if it loses money, then they have to pay you to compensate you for your loss.
but you're receiving a floating rate from the swap
That's
dealer.
right. That's right.
So
So
you
you see how this could really work out pretty well. So let's say this gain turns out to be minus 10%. If I'm
yeah.
if I owe the dealer not minus 10%, that means he owes me 10%.
So if the stock goes down, you're
I,
getting the
I
delta
get
between the two, and you're getting paid LIBOR on top.
that's right. Yeah.
And the stock, why would a swap dealer go into this sort of agreement? Because they believe the stock to be going up, I would assume.
Oh, because they're yeah, either that or they've got somebody else they can trade this to for a
Okay.
slightly lower rate of interest. Yeah, they're thinking about where can we sell this to somebody else basically. Um, they're I mean, unless they're really serious about this and they say, we think IBM is going through the roof next year, so we're happy to do this.
Yeah.
But they'll probably just match up those cash flows with somebody else and get some rate of return in exchange for that. So, it's like with foreign exchange dealers, they're not really in the business to gamble on currencies. They're just there to make transactions and make a small profit on each one.
Right. Because there's probably someone on the other end that they can then sell that to.
Somebody else has the exact opposite outlook, and
Right.
they'll be happy to take the other position.
Okay.
Yeah.
So they're going to
Yeah.
make a swap on the swap.
Right, exactly. Those cash flows now will get traded to somebody else, let's say for LIBOR plus 0.1% or something.
Got it. But if the stock ends up going up, all they receive is LIBOR.
Right.
Okay.
Oh yeah, if the pension fund is wrong and IBM has a wonderfully good year, they're just going to get LIBOR. They're not going to get any of that capital gains or dividends.
Yeah, which means they lose out. Okay.
Yeah. So they might kick themselves, but at least they're getting something. It depends on what they think is going to happen. But with commodities, now with the commodities, you're not usually doing this with the actual commodities. There are indices in the market. There's one or two in particular that are very widely watched. Let me see if I can find one. God.
Would you that last example, is that done through an exchange? The IBM for LIBOR?
No, these are all over the counter.
Over the counter. Okay.
Yeah. An exchange would imply that there's so much volume and trading in that
Right.
particular setup that they can justify offering it on, let's say, the CME. It's so specialized to the needs of the two who made that trade that kind of thing would almost certainly take place in the over the counter. There are no exchange traded swaps.
So theoretically, couldn't the swap dealer default?
Oh, absolutely. Yes, definitely. There's always that risk. But the swap dealer is probably like one of the big investment banks like Goldman Sachs or,
Sure. Because
not the
none of
big,
those have ever defaulted.
right, that's right. But
Yeah.
let's just say it's low probability. Yes. All these
Right.
over-the-counter transactions all have some credit risk attached to them.
But
In
in
fact,
that
swaps,
scenario, you would still keep the IBM securities. You would just stop receiving LIBOR.
yeah, the cash flows were just stopped. That's all.
Okay.
Because you never actually sold the stock. You still own it. It's just that there's nobody to trade cash flows with now.
Right. Okay. Thank you.
So I'm gonna look up to see what commodity indices are that we can choose from. Now, of course, you can always, if you really want to invest in commodities, you can always get an exchange traded fund. Um, but just as far as using these swaps, there used to be one, I think, I don't know why the name Kansas City is coming into my mind. There's obviously several different commodity indexes, but I can't remember. There were one or two that were very popular. I guess it depends on what commodities they are. If they're like agricultural or if they're metals. What the hell is this? There's an ad trying to pop up here that I don't want. For Mazdas, for God's sake. I didn't ask for that. Okay, CRB, Commodity Research Board. Now I can remember, yes. Um, and these are the commodities. These are some commodities. Oh, here it is. Thomson Reuters Core Commodities CRB is calculated using an arithmetic average of commodities futures prices with monthly rebalancing. It consists of the following 19 commodities. You can see it's a whole slew of them: aluminum, cocoa, coffee, copper, et cetera, et cetera, et cetera. And then they are sorted into four groups: energy, agriculture, precious metals, base industrial metals. So what that means then is if you really want to invest in these, you don't never have to actually take possession of these commodities. You can buy what's called an exchange traded fund, which basically is a collection of assets that trades as a single, as if it were a single stock. So, it gives you an opportunity to invest in things that would be difficult otherwise. So, here, the CRB, this Commodity Research Board, has, oh, there it is. The current level is about 364. So if you're in the business, let's say you do a lot of business, you buy and sell commodities, or you're a manufacturer who buys a lot of commodities, and you're worried that commodity prices will start going up. What can you do? Well, you can enter into one of these swaps. Gotta get rid of that. Wait a minute. Yes, there's a couple of possibilities here. A fixed or floating rate commodity swap is similar to a fixed or floating rate interest rate, except that the floating rate is based on the commodity index, like the CRB. So the CRB, Commodity Research Bureau, produces an index called the CRB Spot Index, which, as we just saw, reflects the prices of many commodities, 19 of them specifically. And so if you're worried about commodity, let's think about this. Let's say that you think that this index is going down. Then you can get into a swap where you trade it to the dealer in exchange for a floating rate of interest, let's say. So that way, if you're right and the index goes down, you're still collecting this floating rate of interest. But let's say you think it's going up, you can enter into it one of these swaps and you pay the floating rate in exchange for the CRB index. So, but some of these situations are not as useful as they used to be. Like I was saying, that if you just want to invest directly in commodities, you can buy an exchange traded fund, which is based on this index. And then that way you'll make whatever money the index makes without having to get involved with one of these swaps. Usually these are designed so that you can just take an exposure you already have that you're not happy about and trade it for one that you are happy about, or vice versa. So there's a lot of reasons why you might want to enter into one of these, but it's kind of interesting. You can trade one type of exposure for another without any real difficulty. And since this is an over-the-counter market, it doesn't matter what exposure you have. You should be able to find somebody else who's willing to take the other side of one of these swaps. So let's say that you're a nickel manufacturer. You could trade the price of nickel for a fixed rate of interest or something like that, depending on what you expect to happen in the marketplace. Now, there's also commodity for interest rate swap means it's like the equity swap, except the total return is based on a commodity instead of a stock. Okay, so it's like the stock one we had here. except that the returns are based on commodities instead of stocks. All right, now here's an interesting twist. We have a forward swap, which means that you're entering into a forward contract, which you agree to in the future enter into a swap. And then you have to specify whether you'll be the fixed rate payer or the fixed rate receiver. And then you also have to specify what the fixed rate of interest will be. But this way, let's say you want to hedge a risk that doesn't occur just yet in 6 months, but you want to lock in the fixed rate of interest. This is one way you could do that. Okay. So let's say you want to enter into a swap paying the fixed rate for the floating rate, but you don't want that rate to go up in the future. So enter into this contract now so you can lock in the current forward fixed rate instead of having to wait 6 months and worry about it going up. So we have a forward swap. And we also, I don't think I mentioned it here, but oh, wait a minute. So here, just to be a little more specific, if you enter into what's called a long forward swap, then that means you're entering into an agreement to become the fixed rate payer, where the swap rate at which you pay is fixed in the contract, which means, of course, that if you're the short forward swap, that means you're entering the fixed for floating rate swap as the floating rate payer. And again, the fixed rate is settled in advance. Now we also have, I think I mentioned this, and we'll see it again later on in the course. We also have options on swaps, which are known as swaptions. All right. So we combine the two here. A swaption is an option to enter into a fixed for floating rate swap. Now, I think the call is the one that lets you become the fixed rate pair, but we'd have to double check that. So we're going to see there's a chapter later on where we're looking at interest rate options, and this will be one of them. Okay, where we focus specifically on options that give you the right to take a position in interest rate. So the name swaption means option on a swap, which of course the advantage of that is that you don't have to actually go through with it, whereas with the forward swap you do. It's a legally binding agreement. Okay. So that we'll see later on. Now these are fairly complicated to price, but I forgot what chapter this comes up in. We're definitely going to get back to this later on. And so and now later on, what's interesting is that these are all markets. These swaps are all based on market variables. Down the road in the, let's say, early 90s, we started seeing the introduction of these different swaps that are based on credit risk. And so what would happen is with a credit swap, it's a little bit different because what happens is an investor who's exposed to credit risk can enter into a credit swap. Actually, I'm sorry, it's called a credit default swap or CDS. In which the investor pays a premium on a periodic basis, let's say every year. Actually, let me change that periodically. Or no, let's use a specific example. Pays a premium on a regular basis. Let's say every year or every 6 months. And in exchange for that, a payment in the event that an asset that he owns defaults. Okay, so that let me just give you a very specific example of that. For example, let's say a pension fund owns a bond that is rated triple B minus. All right, now that's the lowest possible rating. It still qualifies as investment grade. And it's making them nervous, right? Let's say they're not allowed to own anything that's riskier than that. The pension fund is worried that the issuer of the bond could declare bankruptcy. Now, of course, that would have a catastrophic effect on the price of the bond. But for whatever reason, let's say the bond is too illiquid for the pension fund to sell, except at a loss. All right, so if they try to sell it, they'll just lose money. But they also think this situation is temporary. Right? Let's just pile on the assumptions here. What can they do aside from simply selling the bond? All right, so here's another option. With a credit default swap, the pension fund enters into, agrees with the dealer to pay a fixed amount of money each year. Whatever it is, they figure this out, depending on the credit rating of the bond. For example, let's say $10,000. In exchange for this, if the triple B minus bond is either downgraded by the rating agencies or the issuer declares bankruptcy, the counterparty, or the dealer, I should say, must pay a sum to pension fund, compensate them for their loss. So in other words, if the let's say S&P 500 or S&P downgrades this to double B plus, and the bond's value goes down by $5,000, that means the dealer has to pay this pension fund $5,000. Or if the company goes bankrupt and the value of the bond goes down by $50,000, then that's how much money the dealer has to pay. So you've got cash flows going one way every year, and only cash flows coming the other way if there's a credit event like that. So sometimes in these books, you see the cash flows written in a very interesting way. You've got the pension fund, which is collecting some payment from this triple B minus bond, whatever it is. And then what they do is they go to the dealer. They say, listen, we'll give you some fixed amount of premium. Let's say, I'll just say $10,000 per year. Let's say the triple B bond is paying 6%. Coming this way, you see this often with these books. The dashed line means this is contingent on a credit event for this bond. And this is compensation for the pension fund's losses if there is such an event. That means that what you're effectively doing here is buying an insurance policy on your bond. I mean, that's really what this is. It means I pay a premium to the dealer And if I lose money because there's a credit event, they have to compensate me for that. So it's not like the others in the sense that the cash flows are guaranteed. Here, the cash flow from the dealer to the pension fund only takes place if there's a credit event. But the fund has to pay the premium every year to the dealer, no matter what. And they also get to keep the bond. Now, during the housing crisis, what we saw was a lot of these dealers didn't have the money to back up any losses that might take place. And so a lot of these contracts were never honored. And that really was part of the problem, that a lot of people were buying relatively risky assets thinking it doesn't matter what happens, I've got protection in the form of these credit default swaps. And a lot of them were never honored. So it just magnified losses throughout the financial system. And like imagine if I had a CDS in place with Lehman Brothers, what good does it do me? They don't have the money to cover their losses. So I'm stuck. I just have to accept my loss on this triple B bond, which just went bankrupt. So yeah, that was a very scandalous time in U.S. history. A lot of these companies were selling CDSs without having any funds to back up any potential losses because they were based on assets that were believed to be a lot safer than they really were. So there was a lot going on at that point in time, which if you've seen the movie The Big Short, it got really ugly for a while there. And thankfully the Fed was able to straighten things out. But so that's what these were, and they're very popular. I'm sure they're still being traded today. It's just that I think everybody's being a little bit more careful with them, and probably they're being required to host a certain amount of collateral to be allowed to even deal in this market because we don't want that to happen again. But anyway, so these are a little bit different because these are credit products. Up to this point, we've only been looking at products that are designed to hedge market risk. If you look at the derivatives markets, for all practical purposes, most of them are designed to hedge market risk, but a large number of them are designed to hedge credit risk as well, or in addition. So they're really kind of two separate markets. But anyway, yes, so this market is quite large. And so you can imagine the volume of trading in swaps is quite large, especially with foreign exchange and interest rate swaps. But the thing about these is that the sky's the limit because they're being put together in the over-the-counter market. I'm sure there's many other types that we haven't even thought of. Wonder if we could find an article about this. Let's see, where are we? All right, Investopedia. Well, they mentioned the interest rate swaps, of course. Man, I just can't get rid of these ads. Here we go. We have, and you notice they're already changing the examples to SOFR. They didn't even mention LIBOR here. Oh, these are some nice, look at that. Nice diagrams. Currency swaps. Commodity swaps, we already know how that works. Credit default swaps, which you just discussed. Zero coupon swaps. Oh, all right. So the only real difference here is that with a fixed to floating rate zero coupon swap, the fixed rate cash flows only, instead of being paid periodically, are paid at the end of the contract. Now, the reason why you might do that is because you own a bond, which is itself a zero coupon bond. Now, I don't know if you've ever seen zero coupon bonds, but what's different there is that you're basically not really even receiving coupons. What's happening is But a zero coupon bond is sold at a discount from the face value and is then redeemed at the full face value. The difference between prices is the capital gain to the owner of the bond. And so let's say just quickly, for example, an investor buys a 1-year treasury bill. This is how treasury bills are set up in the market. An investor buys a 1-year treasury bill with a face value of $1 million and pays $980, let's say, today for this treasury bill. 1 year, he receives $1 million. So therefore, his capital gain is $20,000, which is a rate of return of 20,000 over 980,000, which is equal to, let's find out, about 2.04%. So in other words, the treasury bill is a zero coupon bond. It doesn't actually pay coupons. Instead, you buy it at a discount and you redeem it at the full face value. So you're actually earning a capital gain. So these are referred to as zero coupon bonds. So if you own one of these, you can see why with a swap, if you're trying to exchange, let's say the return on this bill for a floating rate, it would be more convenient for you to only pay the fixed rate at the end of the maturity of this zero coupon bond, because in the meantime, you won't have the money. So you can see why that might be a sensible swap to take if you own a zero coupon bond and you're trying to swap out its cash flows. You don't want to be making the cash flows every year because you simply don't have the money. Ooh, now look at this. Sometimes taxes used in tax swaps are used in tax arbitrage, allowing parties to reduce tax liabilities by moving cash flows between jurisdictions between different tax rates. Ooh. And the total rate swap means that you actually are essentially able to collect returns on a security in exchange for some rate of interest. So anyway, yeah, so the market is massive. And it's a relatively new invention. They've only been around since the early 80s, which is fairly new, but compared to the other derivatives out there. Now, what's coming up after this, by the way, let's see if I still have Brightspace open. Oh, yes, I do. If you look ahead to next week, you'll see, what do you see? Options. All right. Now, I did say that we're going to spend a lot of time with options. So next week, we're going to take a much deeper look at option markets and the features of options. We're not going to start pricing them just yet, but we are going to look at strategies that we can undertake with them. And we're also going to learn about other kinds of options besides the standard ones. And so I think in week 5 is when we're going to start actually trying to price them. Oh, no, we're going to analyze them. Oh, yeah, no, we got a lot of analyzing to do here. The pricing will probably come up in week 6, but anyway, so the swaps discussion is usually the shortest of them all, so we're actually kind of finished with all the material about swaps now. So there is an assignment here, but there's a template to go with it. And if you have trouble downloading it from here, which is very possible, unless it's just my computer. See, when I opened it before, right about here, it said opening in protected view, and then it refused to open. So well, that's why I said I better anytime we have Excel, I guess what I'd better do, just to be on the safe side, is send you a copy of the spreadsheets by email because we can't have this. I knew this was a problem, and they just keep telling me that there isn't a problem, and I don't know what to do about it. So that's what I'll do. That way, otherwise you won't be able to get your assignment done. Either that or it's just being painfully slow. Anyway, so I guess unfortunately we'll have to stop right here. Yeah, see, it won't open it. It refuses to open it. It's just ridiculous. So all right, so we're done for tonight. We didn't have a break, so I guess we're right where we should be. And so you do have an assignment. You should use the template for that. Like I said, I'll send you a copy of email because you may not be able to open it. And then that way you'll be able to get your work done. And then the following week, next week, we'll be looking at the first of 4 or 5 consecutive weeks of options. Because it's such a complicated but important market that it does justify spending most of the course with options. So that's where we're heading next week. Okay. So I guess I'll see you all next week then. All right. Good night.
Thank you.
Thank you.
Bye. All right. Bye.